Bitcoin isn't just falling. It's slipping through the floor in a way that should have people screaming, and somehow they're not. Price is hovering near $65,000, roughly 48% off the peak, and the bigger tell isn't the percentage, it's where it's happening. We've now lost a level that used to be a psychological line in the sand, the kind of level markets remember, the kind of level that usually separates normal turbulence from something is structurally shifting. But the real signal isn't the break, it's the behavior. Because this isn't what a normal dump looks like. There's no public meltdown, no stampede, no single day where everyone gets flushed and you can almost hear the capitulation, no dramatic final wick that feels like the market getting exercised. Instead, it's been clean. Day after day, the same direction. Not violent, not emotional, just consistent, like the market is being walked down a staircase. And that's what should make your skin crawl a little. Because when retail breaks, it's messy, it's loud, it's impulsive, it's chaotic. But when large money reduces exposure, it doesn't need drama. It executes, it grinds, it applies weight. And this move has weight. That's why this moment matters, not because Bitcoin is down. Bitcoin being down is part of the contract. Volatility is the admission price. What's different is the texture of the selling. This isn't a tantrum, it's a controlled unwind. And that creates a much more uncomfortable question than why is Bitcoin dropping? The question is, what kind of player sells like this? And what are they reacting to before everyone else has a clue? Because this doesn't read like panic, it reads like pressure. And here's the part most people are missing. This isn't only about Bitcoin. At the same time Bitcoin is sliding, stocks are getting hit, bonds are shaking, gold and silver are moving weird, and even currencies are acting nervous. That's a clue. When everything starts wobbling together, it usually means one thing. The market is pulling back from risk. People aren't debating stories anymore. They're reducing exposure. And big money doesn't sell like this because of a tweet. They sell like this when something bigger changes in the background. Now watch what happens next. The moment price drops like this, FUD explodes. And it doesn't come one at a time. It comes like a swarm. One group says an exchange is about to blow up. Another says regulators are coming for crypto. Then ETFs are bleeding. Then miners are under pressure. Then the old classic, quantum computers will break Bitcoin. And if that's not enough, you get the circus, Satoshi's identity, conspiracy threads, wild claims with zero proof. And the real problem isn't even which one is true, it's that all of them hit you at once. Because everyone is fighting for the same thing, your attention and your fear. So no, the real question isn't just why is Bitcoin falling? The real question is, what does this moment show you about markets when confidence starts breaking? Because when price drops fast, people don't handle "I don't know" very well. They can't accept randomness, so they start grabbing for explanations, any explanation, even bad ones. That's when stories multiply. That's when people see patterns that aren't real. That's when fear turns into proof. So this isn't only a Bitcoin move, it's a live test of how humans behave when the market stops feeling safe. So here's what we're going to do. I'll show you 3 things. First, why this looks less like a Bitcoin problem and more like the whole market repricing risk at the same time. Second, what this slow, steady selling tells you about who is actually selling and why they're doing it this way. And third, where we likely are in the bigger cycle, using history and a few simple signals, not hype, not guesses. Because once you can separate signal from noise, this stops feeling like chaos. Because in moments like this, one thing matters more than anything else. Can you tell the difference between noise and signal? If you can't, the market will take your Bitcoin and hand it to someone who can stay calm. That's how this game works. While everyone else is glued to headlines, refreshing charts, and arguing online, the real decisions are being made quietly. And this is where staying calm isn't confidence, it's survival. Quick side note before we go. I put together a simple guide that helps you stress test your plan during moments like this, because most people only realize the weak spots when it's already too late. It's free, and I only ask for an email so I can send it to you. I don't store your data or track anything else. Links in the description. Now, back to what's actually happening. To understand this, you need a simple picture. Think of the market like a game of chicken. You've got the Federal Reserve, you've got banks, big funds, market makers, governments, and then retail watching everyone else for clues. Everyone is moving forward, pretending everything is fine, while secretly watching the others. No one wants to be the first to slow down, because slowing down looks weak. Bitcoin's price right now isn't moving because Bitcoin suddenly changed. It's moving because someone eased off the gas. And now everyone else is trying to figure out who did it and what they saw coming. Here's a rule most people don't like to admit. Price moves first. Stories come later.
The market doesn't wait for a clean explanation before it moves. It moves, and then humans rush in to explain what just happened. That's why FUD explodes after the drop, not before it. Most of it isn't information. It's the brain trying to protect itself from uncertainty. Randomness feels dangerous, so people turn it into stories they can hold on to. The problem is, once fear becomes a story, it spreads fast, and price doesn't care whether the story is true or not. Now let's anchor this with a little data. Not predictions, just context. Right now, momentum indicators like RSI are pushed into extreme territory, levels you usually don't see unless selling has become very one-sided. That doesn't tell you where price goes tomorrow, it tells you how stretched sentiment already is. At the same time, price is hovering near long-term cycle levels, areas that historically separate normal corrections from deeper fear phases. These are zones where forced sellers usually finish and long-term buyers start paying attention. This isn't me calling a bottom, it's just a reminder. When indicators look like this, you're no longer early in the fear, you're deep inside it. Now let's deal with the stories people are throwing around, because once price starts falling, everyone starts hunting for a villain. Theory 1. Coordinated selling. The idea is that big players are pushing price down on purpose so they can buy cheaper later. It sounds smart, it sounds strategic, and that's why people love it. But here's the problem. Markets don't reward cooperation, they reward cheating. If one big player tries to push price down quietly, another one sees it and buys before them. That's how game theory works. Coordination breaks fast when money's on the line. So yes, some players might be selling on purpose, but blaming the entire move on a perfectly organized plan gives the market way too much credit. Theory 2. Exchange collapse rumors. This one is more serious because we've seen it before. Here's the truth. An exchange doesn't have to actually fail to cause damage. If enough people believe it might fail, they rush to withdraw, and that rush can create the exact problem everyone feared. That's how bank runs work. Do I know if any exchange is in trouble? No, and neither does Twitter. But here's the key difference. Not knowing doesn't mean doing nothing. It means managing risk anyway. That's why smart holders don't leave long-term assets in someone else's hands. Theory 3. The quantum doom story. This one shows up every bear phase. Yes, in theory, future technology could challenge today's cryptography, but we are nowhere near that point. And even if we were, Bitcoin isn't frozen in time. It can upgrade. It always has. But fear doesn't wait for technical details. Fear hears quantum and fills in the rest. And then there's the truly ridiculous stuff. Secret identities, hidden masterminds, wild conspiracies with zero evidence. And while it's easy to laugh at them, they matter for one reason. When markets get stressful, people start connecting dots that aren't there. Pattern matching goes into overdrive. Nonsense spreads faster than facts. That's not insight, that's psychology under pressure.
Now here's what actually matters. If you're looking for one clean trigger behind this move, it isn't some secret Bitcoin flaw, it's liquidity. Rates stayed higher for longer, funding got tighter, and expectations around the central bank shifted. Markets started to realize that easy money wasn't coming back as fast as they hoped. And when liquidity tightens, risk assets feel it first. Bitcoin didn't suddenly change. The code didn't change, the supply didn't change. What changed was how much money was sloshing around the system. And when liquidity pulls back, price adjusts, fast. To understand where this all leads, you need to understand one thing. The system doesn't have unlimited choices, it has limits. Think of it like 4 doors. Door 1, cut spending hard. Sounds good in theory. In reality, it's politically impossible. No government survives massive cuts that actually fix the problem. Door 2, raise taxes. That helps a little, but only to a point. Push too hard and money leaves, businesses slow down, and growth dies. You can't tax your way out of a debt problem forever. Door 3, default. That would mean refusing to pay debts. But when your debt is in your own currency and you control the printer, default makes no sense. Which leaves door 4, print more money. Inflate the problem away. Devalue the currency over time. It's not the popular choice, it's not the honest choice, but it's the only door that's actually open. And eventually, printing always wins. And this is where people get fooled, because the system doesn't always announce we're printing again with a big headline. It often comes quietly with a new label. They call it market operations. They call it liquidity support. They call it temporary tools. But if the result is the central bank adding support so the system doesn't seize up, it's the same thing in practice. It's easing, just wearing a different outfit. And here's the pattern. Stress builds, something starts cracking, funding gets tight, yields spike, auctions get shaky, credit starts freezing. Then the response comes. Maybe it's small at first, then bigger, then suddenly it's full support again, because they can't let the whole machine stop. And when that switch flips, Bitcoin doesn't move slowly, it reprices violently, because it's reacting to the one thing that matters most, money getting easier again. Now let me show you what this looks like in the real world. Imagine you're managing a large portfolio. Stocks are down, bonds aren't protecting you, everything is under pressure at the same time. Your phone starts ringing. Investors want answers. The board wants explanations. You can't dump everything. You can't sell all your stocks overnight. You can't unwind bonds without making the problem worse. But there's one thing you can sell: Bitcoin. It's the most volatile, it's the easiest to point at, and it gives you a clean excuse. We're reducing risk. That decision isn't about long-term belief, it's about career survival. And when thousands of managers make that same decision at the same time, you don't get panic, you get days of slow, steady selling. Not emotion, process. So this isn't Bitcoin breaking. This is the whole market pulling back from risk at the same time. When that happens, everything drops together. Stocks, crypto, metals, even bonds. Everything starts moving as one.
Bitcoin just looks worse because it moves more. There's a name for what's happening here. It's called knowledge arbitrage. It's when price moves faster than understanding. The market reacts before most people fully grasp what's really going on. Right now, you've got 2 groups. One group sees Bitcoin as a risky bet, a casino, something you trade when things feel good and dump when they don't. The other group sees Bitcoin as protection, a response to a system that has no choice but to print and devalue over time. When price falls, the first group panics. They have nothing to lean on. The second group feels something else, not comfort, but conviction. And conviction at moments like this feels lonely. I've been on both sides of this. I bought Bitcoin when things felt obvious, when price was high and confidence was everywhere. Then I wrote it down, hard. There were moments I questioned everything, not the charts, the idea. I asked myself if I was wrong, so I went back to basics. Did the debt problem disappear? No. Did government stop needing to print? No. Did Bitcoin's supply suddenly change? No. The price moved, the fundamentals didn't. And that's where real conviction gets built, not at the top, but when holding feels uncomfortable. And the people who hold through these cycles aren't reckless. They come from everywhere. Engineers, business owners, doctors, traders, builders, people who are used to thinking for themselves. They didn't get here by hype. They got here by asking hard questions and following the logic all the way through. They're not gamblers chasing a chart. They're builders protecting the future. So what do you actually do from here? First, be honest about downside. Bitcoin can still go lower. Pretending it can't is how people break when it does. Acknowledging risk doesn't weaken your plan, it strengthens it. Second, if you're accumulating, consistency beats timing. Don't try to catch the perfect bottom, just keep buying in small, regular amounts. It's boring, it's not flashy, and it works. Third, take custody seriously. If this is a long-term hold, it shouldn't live on an exchange. Learn self-custody, set up backups. Think about structure and planning now, not later. That's how you survive volatility and stay in the game. Now, do a simple reality check. Scenario 1, the central bank gives up, eases policy, and money gets easier. Bitcoin moves fast. Scenario 2, they stay tough, keep pressure on, and something breaks. Markets seize up, and then they print anyway. Different paths, same destination. The only thing nobody knows is when. Quick story. A guy I know calls me during a drop like this, completely stressed. Should I sell? Should I stop buying? I ask him one question. Did you buy Bitcoin because you thought it would never go down? Silence. Then he says, no, I bought it because the system has to print. I said, so nothing changed. Call ends. A few weeks later, I get a text, bought more. That's the whole game. Here's the painful version. After a major crash, someone I know sold all his Bitcoin, took the loss, couldn't handle the stress anymore. He told himself he'd buy back later when things felt safe. Months passed, price went higher. He didn't feel relief, he felt anger at the market, at Bitcoin, mostly at himself. And someone told him a line he never forgot. Bitcoin doesn't punish you, you punish yourself. Bitcoin just sits there being Bitcoin. He never bought back in. He's still waiting for the perfect moment. That moment already passed. Remember the game of chicken we talked about earlier? The people who lose are the ones who blink first, not because price dropped, but because they never fully understood what they owned. The people who win are the ones who understand the limits of the system, the ones who know how this ends and who keep accumulating while everyone else is rushing for the exits. That's the difference. So no, Bitcoin isn't breaking. What's breaking is confidence. What's breaking is understanding. The market always reprices risk first, and understanding comes later. That gap is where fear lives, and that gap is where opportunity is born.